Traders, welcome to Market Outlook, Trends, Risk Events, and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. So, whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll just follow the usual format. So, we'll just check out how markets are trading currently and some of the news headlines. We'll look at stocks and some of the technicals and charts before then getting straight into a load of risk events that we have seen recently. So we'll look at non-farm payrolls, we'll look at the central bank meetings from the Fed, the RBA, and the Bank of Canada, as well as all the associated currency pairs. We'll then get into a preview of this week's main events. They include the US CPI data on Thursday, as well as central bank meetings, again, major central bank meetings in the form of Bank of England, Bank of Japan, and also the ECB. So there we go. That's what we're hoping to get through in the next 30 minutes or so. Just on the headline front and how markets are shaping up, President Trump, he's due to give an address to the US on Wednesday night, tonight at 9 p.m. local time, Eastern time, that is. White House press secretary says that Trump's address will be about his accomplishments, while he will talk about what's to come and maybe tease some New Year policies. European markets are mostly stronger this morning, with FTSE 100 leading the way up, was up over 1.5%, getting closer to record highs. US equity futures also posting modest upside. The dollar is firmer, while the pound has been hit after cooler than expected inflation data, which near enough cements the Bank of England cut for this week. We'll get into that later. Gilts are outperforming, obviously yields going lower on that data, whilst US Treasuries are holding a downward bias in price. Crude, interestingly, that's reversing Tuesday's losses, which hit multi-year lows following the blockade of Venezuelan oil tankers and reports of new Russian energy sanctions if Russia rejects the peace deal. Gold and copper trading with slight gains, while silver races ahead. Incredible rally this year, up 126%, I think it is, and above $66 at one point. Gold not anywhere near that, but still trading below those record highs. Global equities, just quickly then, they ended yesterday's session 0.4% lower following a busy data day again. Performance driven by actually the more cyclical and sentiment sensitive sectors, with tech and consumer discretionary leading the declines, the latter dragged down by Tesla. S&P 500, that ended 0.2% lower, despite almost 75% of the constituents ending the day lower. Nasdaq, that gained 0.2%. Tesla actually, sorry, wasn't down, it was up again, as it hit record highs actually, on robotaxi tests announced on Monday, actually, while the Russell 2000 and Eurostock 600, that ended the day both around 0.5% lower. Yesterday, that was. Okay, we've just got this chart in here that we showed you last week, actually, just expectations from major central investment banks on what they expect the S&P to finish next year. Pretty much double-digit gains of around 10%, so lower than the sort of 13-14% gains we may get this year, and also the average over the past decade, actually. But still positive, decent performance, really. And that would see the S&P finish around 7,500 by the end of next year, as I say, so a 10% gain. That is, of course, in amongst all the worries about an AI bubble, although we are now seeing a rotation out of some of the AI names, especially those 41 names that one of the investment banks named as being AI centric, and a move out in towards more defensive sectors, including healthcare, materials, utilities. But we are seeing that already. So interesting to see what theme develops going forward next year. We have got the seasonality chart in here as well, still just pointing out that generally December is a positive month for the risk assets, but at the moment pausing slightly. If we just pull up the chart then of the S&P 500, which is here. You can just see we're just tapping now the 50-day moving average. That's at 67.65. You've got the record high at 69.20, and we're just rolling over slightly. So next support level, the minor fib level, 66.48, and then you've got the 100-day moving average, which tapped the downside, capped the downside even. That's at 66.34. For the Nasdaq, similar chart, we're just down below the 50-day moving average now. That's at 25,212, so that's just above current prices. Minor fib level at 24,867, record high at 26,182. And then you've got the Dow as well, has been performing well, just hit a record high last Friday at 48,886. So that fib level really needs to go higher. But now we've just dipped down below that previous high from mid-November at 48,431. But we've got the 50-day way below at 47,134. Just shows you how well the Dow has been doing in recent weeks. Okay, let's move on then to the recent events that we have seen. First up is non-farm payrolls that came out yesterday. We had both October and November job reports released following the government shutdown, although October's came without the unemployment rate due to data gathering issues from the household survey during the government shutdown. So the November headline, that was the key one, NFP number that saw 64,000 jobs added above the 50,000 forecast then. The unemployment rate that spiked actually to 4.6 from 4.4%, so the highest in 4 years actually, and above the year-end median projection of 4.5%. Is worth stressing though that the BLS announced on Monday that the November household survey has a slightly larger standard error, and these higher standard errors may last a few months. The participation rate rose to 62.5 from 62.4%. And then regarding wages, they were soft, interestingly enough. 0.1% was actually the month on month reading, below the 0.3% forecast. And then the year on year number, which we have here, that was at 3.5%. So beneath the 3.6% forecast, and actually also the weakest, as we put here, in 4 years. Um, Just for your guide, we should point out the October payrolls. We have put them in here. That headline print was actually negative 105,000, but that was actually primarily due to 162,000 drop in the federal government layoffs amid the government shutdown. So just bear that in mind, because then that brings down the 3-month average that we put in here is down to around now 22,000. So interesting report, really, and especially with regard to the Fed and what Chair Powell said last week. We'll get into that in more depth, the Fed, but regarding the overall non-farm payrolls, Powell actually suggested it is being overstated by 60,000 per month before accounting for annual revisions, implying real job growth actually in November then would be just 4,000. Overall, in the data, well, it kind of had little impact on Fed market pricing. No real game changer, really. 6 basis points of easing still priced in for January. That's around 25% chance of another rate cut. And then it's a sort of near 50-50 bet for a March rate cut of 25 basis points. Bottom line, then, no game changer really. Job creation continues to slow. Unemployment is on the rise. And that really means that the doves at the Federal Reserve will continue to make the case for further interest rate cuts. This is the chart just previously that we showed you, preview. Reuters had a consensus estimate of 35,000, so it was a beat on that front, but softer wages and higher unemployment, of course. Moving on then to the Fed meeting from last week. And sorry, bear with me 1 second. and the projections, of course, that we got from the Fed. Just before that, this matrix actually will just yeah, just get into the broader details. They cut policy rate for the third consecutive meeting by 25 basis points, of course, to 3.5 to 3.75%, that target range now. Of course, they have to balance, as we said in the preview, a weakening labour market against somewhat elevated inflation still. There was no consensus within the FOMC on how to address really those opposing factors. So we had one member, Stephen Miram, very big outlier, voting for a 50 basis point cut. But then we had two others, Schmidt and Goolsbee. They wanted to keep the policy rate unchanged. And even in the updated dot plots that we got, that showed a total of 6 out of 19 members actually voted in favour of leaving rates where they were, the status quo. Just on some of those projections then, so the median federal funds rate projection for 2026, 2027 remained unchanged, basically at respectively 3.25 to 3.5%. That's this lower line here. That's the midpoint, of course, on this matrix. And then 2027 at 3 to 3.25%. So just one rate cut expected, 25 basis point cut expected next year, and then another for 2027. Fed Chair Powell, though, he indicated that policy rate now is within the range of plausible neutral estimates, and that allows then the Fed to assess incoming data with really a January rate cut seen as rather unlikely. That said, part of Powell's analysis actually allowed the market to consider really a less hawkish interpretation because we did have PCE inflation forecasts that you can see here for this year and next being moved lower. But then on the flip side, we had growth forecasts that you can see on the top line seeing upward revisions. Basically, you kind of think Powell's working sort of function hypothesis really is still that most of the current elevated inflation was temporary due to higher goods prices driven by tariffs. Services inflation has been cooling. And then in addition, he pointed out at ongoing downside risks to the labour market were probably more important. That's what markets grabbed onto. And especially, as he said, current estimates on employment growth probably present an overestimation. That's what markets responded to, as I said last week, that sort of dovish opening created by the labour market remarks. All in, though, you have to think as well that if we're nearing the neutral interest rate level, then the bar for additional rate cuts, potentially, especially in early 2026 next year, that bar has been raised. So that was the Fed. Interesting meeting, end of the year meeting. And flipping really from this sort of hawkish stance in October, really, then to slightly less hawkish, at least, and not as expected. So much. We also get other data out of the US, actually quite important US retail sales data yesterday. Interesting, the retail control group, which is what officials look at more, that increased by 0.8% month on month, doubled the 0.4% consensus. But then the flip side to that is we did get weak PMI data. Headline PMI data was weak, actually, and a second consecutive month of waning momentum. But then, as well, in this report, a bigger concern possibly is rising costs, and inflation was seen jumping sharply to its highest level since November 2022, and which Fed. Well, yes, and that is an issue potentially for the Fed, and steep increases in selling charges, actually the highest in the past 3 years. So mixed data after the Fed, and that we have seen this week. Sorry, just going back there. If we just pull up then a dollar chart, actually. Just bear with me 1 second. Just pull up the dollar chart. A little bit of a bid today after non-farm payrolls report. We're back up. You can see up to the grey line. That's the 100-day moving average at 98.61. Interesting, you've got the 50-day potentially moving above the black line, which is the 200-day moving average. That is potentially a bullish golden cross sign. And those levels are around 99.22, 99.26, you can see there. So some resistance initially at the 100-day, but then you've got this bullish signal with the 50-day going through and up above the 200-day. Otherwise, you've got the spike low from yesterday after the non-farm payrolls. That's at 97.86 as really the next initial support level. Okay, moving on from this to last week's RBA meeting. That was a hawkish hold. Well, they cut policy rate, I should say, steady at 3.6%. But it was a hawkish hold for sure. The bank's clearly worried now about inflation. They do not like where prices are headed to, and said risks were flipped to the upside. The October monthly report that quickened from 3.6 to 3.8, and that is well above the 2 to 3% target range, of course. And that comes after the Q3 quarterly outcome, and that's kind of the key number for the RBA. That surpassed significantly the RBA's previous expectations. Core gauges also run hotter than the RBA, and the board really sees signs of a more broadly based pickup in inflation, which, against the backdrop of recovering economic activity and still tight labour market conditions, that really needs to be monitored for its persistence. And interestingly, actually, at the press conference, Bullock said, well, the question is, and I quote, is it just an extended hold from here, or is it the possibility of a rate rise? That really a telling remark around the central bank's state of mind. She also said that policymakers hadn't explicitly considered the case for a rate hike, but did discuss the circumstances where one could be needed. So really interesting, very hawkish hold in some ways, and the market in probability for a rate hike really increased significantly after the meeting. Got up to around 40%, I think, for the March meeting next year, but now down to around 20%, but still a significant shift. And the first full rate hike now was pulled forward from sort of August, September time to middle of next year now, June. You can just see the really decent rise in the Aussie dollar, really, as the dollar's come lower. And there's this contrast with more hawkish central bank, potentially the end now of the policy easing cycle and the start of a rate hike cycle, in contrast to potentially the Fed as well. So we've had a really decent run in the Aussie dollar from, well, we've been calling about the range here. So below 64.50 up to sort of 65.50, 66 or so, that decent range. If you play that over the last few months, obviously there's been some breakouts to the upside, but then we've fallen back now, back to sort of 66. You've got the top side then. That's a high from September, at least worth a mention, 67.07. We got up to 66.85, I think it was, 85, yep. And now we've just rolled over for 5 consecutive days. So interesting, really, where the nearest support level is, potentially this swing high from July at 66.25. Otherwise, you've got the 50-day and 100-day moving averages, at 65.39, sort of 65.44 area, which tallies with one of these minor fib levels, actually major fib level, actually from this year's, October's, late September's high down to April's low, with that 61.8 retrace level being at 65.49, tallying with those 100-day and 50-day moving averages. That is sort of strong support, but much lower. Otherwise, probably around these highs, which is where we are currently, actually around sort of 66, just above 66 being initial support for the Aussie. Just moving on to dollar CAD then, and the Bank of Canada as well. Let's just blow this up. Yeah, they held rates as expected as well. So kept rates unchanged. Economic growth at 2.6% annualized in Q2. That was surprisingly strong, the bank said. But that was the result of a steep drop in imports, while the Bank of Canada anticipates a weaker Q4. That said, then growth is forecast to pick up at the start of next year, although uncertainty, of course, does remain high with tariffs and the trade issues. Labour market, similar sort of on the one hand and the other sort of narrative, solid employment gains over the last 3 months. Inflation, that's at 2.2% in October, should remain close to that 2% target, with the Bank of Canada willing really to look through some choppiness in the months ahead. underlying engages, they hover around 2.5%. And really, then the bank concluded that current policy, sorry, is at about the right level to keep inflation close to 2% while helping the economy through this period of structural adjustment. Hawkish side, then, really Bank of Canada as well, similar to the RBA, and really quite a shift last week it was with this idea that some central banks will be more hawkish and looking at rate hikes next year compared to some of the other major central banks, like possibly Bank of England, like possibly the Fed, who are cutting rates. And that's why we've seen an appreciation in those currencies for sure, with the Aussie dollar, as I showed you, and then Canadian dollar. This is dollar Canada, of course, so Canadian dollar strengthening, dollar weakening, and the major going lower. Just on the technical sort of side, you can just see this is from the lows in June up to the high in November. We've got the 61.8 to 137.68, and we're just sort of finding support around there. Halfway point of this move at 138.19, and you've got the black line, the 200-day moving average above that at 138.86. Otherwise, you've got then the minor fib level at 136.67 if we do lose this low from yesterday, which is at 137.30. Okay, moving on then to this week's main events. First up, we get US CPI data. If we just deal with that firstly, just bear with me 1 second. Yeah, first up is CPI data, actually, which I haven't put on there, so apologies, but that's, of course, coming out on Thursday. This release follows the BLS cancellation of October's report due to the shutdown, with October figures to be incorporated into November's data where possible. Recent Fed commentary, interesting, actually, has signaled limited concern over inflation. Powell, he said last week, or he pointed to easing price pressures, continued services disinflation, and largely tariff-driven goods inflation expected to peak in early next year before easing back in the second half of 2026. Powell, he also reiterated actually that long-term inflation expectations, that's key, they remain anchored, and the tariff effects are largely one-off. Fed's tone then sort of seems comfortable with running it hot, if you like, so holding rates as they are, close to neutral, and then, well, the policymakers are well positioned to decide next steps once tariff impacts fade. And also, actually, as we sort of mentioned, just to reiterate again, the Fed is lightly prioritizing labor market weakness over inflation risks in its policy sort of dynamic. Just for your guide, headline in this report, that's seen at 3.1%, core at expected at 3%, falling services prices, specifically shelter, probably likely to offset some tariff-related goods inflation, though some economists do warn of higher cost inputs. That's the CPI data. If we go to now the central bank meetings, we have 3 of those. And for some reason, I've forgotten the ECB meeting. Apologies. But here we are with, first up, the Bank of England meeting. Market expectations fully expect now a 25 basis point rate cut. Markets fully priced for that, as I say, and that especially comes after some of the recent data that we've seen today, actually, and earlier this week. So inflation today actually noticeably stronger on the headline, 3.2% for 3.6. Core and services also lower as well. Services, an important number for the MPC, that's now at 4.4%. And that's come down from 5% in July. Key, though, in amongst this probably is food. That's now fallen down to 4.2% for 4.9%. That has been a concern for Bank of England hawks, who thought that that would then be persistent inflation, which would feed into inflation expectations, longer-term inflation expectations. So quite positive then for the doves, especially. And even though we may see a temporary uptick in inflation in the new year due to air plane tickets, essentially, over the new year, then some economists I have read and then do expect the headline to get or hit 2% by May of next year. Aside from the inflation data that we got today, labor market data as well earlier this week that showed payrolls declining and job losses revised down for September and October. And then also crucially, we had private sector wage growth that dropped as well in October. Below 4% to 3.9 from 4.2%, and that's below the Bank of England forecast of 4.2% actually for Q4. So overall, then, data really does support a rate cut at this meeting. Of course, GDP has contracted for 2 straight months. And even though we had pretty decent PMI data, actually exceeded expectations in both manufacturing and services, generally cast is set really for a rate cut this week. And then going forward, potentially that will be key. Dynamics on the MPC will be interesting. 5-4 vote, of course, very close last time. But Governor Bailey fully expected to vote for a rate cut. That 5-4 vote. I've got to check actually whether they do see the CPI data. So potentially not as close as we think. Although you do have the core hawks on the MPC. So that's Man, Pill, Lombardelli, Green. They may still be slightly reluctant to commit to a deeper sort of easing cycle going forward. That will be key then for markets, the outlook beyond this meeting. Jobs data, of course, will be key, and inflation data as well. But we have seen a big fall in sterling today after the CPI data. If I just pull up that chart, just bear with me 1 second. Yeah, sterling fallen about 0.63% now, so just off its lows. Just bear with me 1 second. Yeah, we have had a decent run. You can see here, and sterling's been one of the best major performers over the last month or so. We fell down to 130.10. This was all before the November budget, of course, but that's been the base for a decent run up to sort of above 134, 134.55 we hit yesterday before falling back. We're just trading around the 200-day moving average now at 133.45, also the 100-day at 133.59. We got the 38.2 retrace of this move lower from that high in July down to the low in November. 38.2s at 133.06. Then you've got the 50-day moving average below that, the blue line at 132.50. Okay, next then ECB. Let's just pull up the euro dollar, which is just euro selling off slightly with this dollar strength. ECB fully expected to hold rates at, the deposit rate at 2%, maintaining a steady stance. Really after after recent upside data surprises, being fairly resilient, the Eurozone economy. And markets really have removed all 2025 and 26 cuts, really, pricing now a pretty flat profile through next year. Growth, as I say, surprised to the upside in Q3. Wage growth and services inflation proving touch stickier than forecast. And then we've had PMIs through October to November stabilized, actually. And that all this data reinforces the ECB's narrative that policy is in a good place. We're likely to hear that again from President Lagarde at the press conference. We do get some updated staff quarterly projections, growth likely to be revised up modestly for this year and next as recent data outperformed assumptions, and then inflation forecasts probably likely to show very modest tweaks, keeping the medium-term path broadly aligned with the 2% target. We do get new projections out to 2028 for what it's worth, and they'll probably showcase a return to steady but subdued expansion. On the governing council front and sort of central bank chatter, if you like, we've had Hawke, Schnabel warning of recently upside inflation risks and validating the market's recent repricing towards a flat curve, if not potential hikes. Flip side to that is we have seen other comments like from Villeroy and Simkus argue that current settings are sufficient and they see no urgency for tightening. General divergence to be expected really underscores why the ECB will avoid committing to a clear path going forward. And of course, President Lagarde's comments in the press conference will be key, although she's really expected to reiterate that policy is well positioned and fully data dependent. Market reaction probably muted unless she goes off script, which is unlikely. Euro dollar, then you can see here 100-day moving average at 116.48, 50-day at 116.09. You've got that recent sort of bearish looking spike actually from yesterday. That's a bearish candle. That's at 118.04. So potentially rolling over down towards the sort of 100-day moving average. Seasonality does point to the dollar selling off in December, but we shall see going into the last couple of weeks. Finally, then, let's just pull up the equivalent Bank of Japan chart with interest rates and where CPI is, of course. Bank of Japan fully expected actually to raise rates now by 25 basis points to 0.75%. That is really only recently, actually, we've seen this quite sharp shift in tone by officials and also the government, actually. So we've had a series of hawkish media leaks signaling, well, the bank was preparing markets for an early expected move. Inflation risk is now central, essentially, is what they're saying. Policymakers fear that delayed tightening could force more abrupt rate hikes later. And then we have heard from Governor Ueda, who emphasized the need to time adjustments carefully to avoid overshooting or falling behind the curve. His key message is really he's framed a hike as easing off the accelerator, I think is what he used, meaning financial conditions would remain broadly supportive. His decision, of course, will hinge on wage trends and then a review of domestic and global economic data. The emphasis, though, certainly is on avoiding policy inertia, really, that allows inflation to build. Interesting, as I said, I mentioned briefly, the government stance has also changed. So we've had reports indicate that the government would tolerate a hike and is unlikely to push back against the Bank of Japan. That gives the political green light, really, reduces one of the traditional constraints on policy shifts. And certainly when the new PM Takaichi was or came into office, then there were some expectations she would push back against it, but that is by all accounts not going to be the case. Going forward, then, policy outlook beyond December, markets expect the Bank of Japan to keep the option of further tightening open as normalization continues. Polls generally show actually most economists expect rates to reach at least 1% by next autumn. That implies a sort of gradual but persistent path higher. The policy statement will be scrutinized, of course, for signals on any signals really on the pace and depth of that shift. And that policy path and messaging around it, of course, will be key for the yen. If I just pull up dollar yen just to finish up. Here, hopefully you can see this dollar yen chart. If I just pull it back slightly. So we're just above the 50-day moving average of 154.29. You've got that recent high just above 158 from November, so just below 158, so 157.89. So we're just hanging around this minor fib level of this year's high to this year's low. That's at 154. Where are we? 154.91 or so, I think. 50-day just below that, 154.24, as I said. The next major fib level down way below at 151.61. So interesting level of support this. If we do break down, then could see a decent move to the downside. Otherwise, support being found here again, near term resistance 156.95, and then 157.89 ahead of 158.87. Okay, we will wrap it up there. Thank you so much for being on the call. I should have said about questions. I think you guys know that, and generally do ask questions when you do have them. Really do appreciate you being on the call for this time, as always. Please do follow us on social media, and we also put out a daily commentary after the US close as well on the website. Okay, take care. Still lots going on, and we will be back on Monday next week, actually. And so we will have time to review and look at some of these central bank meetings and also that US CPI data next week. Okay, take care, and I'll speak to you soon.